Hello again. In a previous video, I presented backtest results for the D volume strategy after I corrected a conceptual error, and it holds some water. So this video covers the IV slope strategy, which suffered from the same issue, but it still holds a lot of potential. So this graph shows the implied volatility futures curve for the SPY. To make the curve, I averaged historical option implied volatilities over all strikes for 371 days. And this data was provided by ORATS. For the case of the SPY, I defined the IV slope as the difference between the IV at 70 days to expiration minus the IV at 15 days expiration. You might choose those days differently for different underlying instruments. I'm not trying to do an accurate curve fit here. I'm just trying to get a bulk sense of the shape of the futures curve. So every day will have its own futures curve. Here's a year of futures curves. The most common curve is Incontango, which is to say that the IV slope is less than 0. It means that the IV of the short-dated options is less than that of the long-dated options. However, during times of market stress, the futures curve actually flips to backwardation, which is to say the IV slope is greater than 0. You can tell obviously that these days are far less common than the typical contango state. Here's a cross plot of IV slope versus daily returns for a year of trading. The dashed line is the IV slope threshold. I'll show you how I computed that in the next slide. So if the IV slope is to the right of this line, we're out of the market. If it's left of the line, then we're in the market. So the pink circle is the most recent data point. So if we recall from the previous video, we're going to use the IV slope measured today to predict the price move tomorrow. That was the mistake I was making before. I was using today's IV slope to predict what had already happened. So we're going to use today's IV slope to predict what's going to happen in the future. If you look at the points with negative IV slope, so days when the IV futures curve was in backwardation, notice that the following day, very often we had a positive move and a big positive move at that. The expectancy of the points over there left of that line is pretty good. Certainly there's some big down moves as well, but the big up moves definitely outweigh it. So if you aren't in the market on these rare days, the day after the IV futures curve flipped to backwardation, then you're going to give up most of your year's gains, interestingly. So how did I obtain that IV slope threshold shown in the previous graph? I back tested a variety of values, and you can see the the profit curve, the profit for each choice here. There's some local variations in that profit curve, but on balance, the profit is high over a broad range of IV slope threshold values. The horizontal dashed line, pink dashed line, is the return of the SPY over the period tested. So it shows us what we have to beat in order to have an edge over just buying and holding. So finally, here's a comparison of the SPY 1 year % return in the green curve versus when the IV slope strategy is active in blue. I've also plotted when the strategy tells you to get out of the market, which is yellow. So we're able to beat the market, at least in this back test, with the IV slope strategy with this particular stock over the past year. It's no guarantee of future performance. So the yellow curve, which tells us when we should have been out of the market, it actually trends downward. So that means that even though in the common situation where the IV slope is to the right of that threshold line, we have a negative expectancy. The IV slope strategy is trying to pick up the big moves that often occur the day after the IV slope flips to backwardation. So I'm not sure I would trade this strategy out of the box. I'm not sure I would get fully out of the market or fully in the market. think I'd rather have some market exposure at all times, but I would just use this signal to to kind of increase exposure when it's active. So if we learned anything, in the last year, buy the dip worked very well on SPY and on many other stocks. And the fact that this works is kind of a conclusion you could draw from buy the dip. So basically, as soon as the market flashes distress, which as soon as that IV futures curve goes into backwardation, it pretty quickly reverses. There's no guarantee that we won't see extended periods of volatility or extended periods of stock market declines in the future. There's no guarantee that the IV curve won't stay in backwardation for an extended period of time while stocks are declining. So caution's in order, but if the current market regime continues, then all indications are that this will work. So as always, I look forward to your comments, and yeah, I can't wait to start trading this tomorrow. See you later.